All right, so here we go. Here's what I got today. All right, dear Todd, we'll be able to pay off our house in the next year and a half. We presently owe 30 something thousand dollars on it. Just happened to get a home evaluation that came up almost 100 grand more than what a lot of the comps are from Zillow, Redfin, Realtor.com, HomeBot, and Value Check, but nonetheless, it's more than enough for income. And they want to take cash out of $120,000 and do a 10-year amortizing loan. So we'll also be checking with additional companies, so please let us know our interest rate, APR, monthly payments, and closing costs. None of which, they're all factors, but none of them are on their own going to help them. I don't know what they want to see those for unless they're looking at a chart like this, which of course they're not, because a couple of things that blow my mind. Number one is they owe 32 grand on this mortgage that they're paying a ridiculously low interest rate on it. We're going to assume it's like 3.75. So a couple of things. First of all, at 3.75, after they get to deduct their taxes, and I know that they are in the 22% income tax bracket. Well, that's my guess. The net cost of this money, even at 3.75, would be under 3%. And where I get that from is just looking at where, and this is the 2019 brackets, but in looking at where they are at 22% for a married joint return, they need to make between $78,000 and $169,000. I'm pretty sure they fall into that category based upon my experience with them before. Maybe it's in the 12, maybe, but I don't think so. Nonetheless, most people, what I've found, are falling into the 22 bracket for a joint return. Two income earners are earning more than this. All right, so made my point there. That means the net cost of their money right now is 2.925, and they are aggressively paying it off through an extra 20 grand towards it. Now, when they did this, if you've watched any of my videos before, equity in your home, 0% rate of return, inaccessible money. So you have to pay somebody to get that 20 grand they just unloaded into that thing back out, which is exactly what they're doing now. And it's the only money in your house that's at risk. So if that house was 650, like this realtor told them, or 560, which is what all the automated valuation models have, the bank didn't lose any money. Only they did if it truly had that big of a variance and equity was to be lost. So nonetheless, I'm not a big fan of paying it off for exactly the reason we have here. Now they're calling me saying, hey, can I write you a check so I can get my own money back that I just threw into that account? They would have been much better throwing it anywhere else. So here's what I put together. Based upon that, and they're going to check because they want to make sure that they're getting a good interest rate, but they want to pay this thing off in the next 18 months. So what people don't realize is there are interest rates and there are closing costs. So in this scenario, in an 18-month time frame, what's more important? Is it the costs and fees, or is it the interest rate APR? It's definitely going to be the costs and fees. So in looking at this, I'm going to be able to show them why they should take an interest rate that is over 1% higher than what the marketed rate would be on a cash out refinance like this to save the most money. So when we look at this chart here, you can see then they wanted a 10-year amortizing loan, whatever. It makes no difference if it's 10 or 15. The rates and terms don't actually change. But most marketed rates are going to be at about 2.5%, and they're going to come with about $3,000 in closing costs. Now, it doesn't matter what the closing cost across the board for these folks. Title work is going to be a set dollar amount. Government fees are going to be a set dollar amount. A credit report's going to be pulled. These are fixed fees, right? So it doesn't matter the loan amount. It doesn't matter the term. It's going to be roughly $2,800 no matter how you slice it. The big difference comes between, are you going to pay a little money to get your low interest rate, or are you going to get a refund or a rebate and take a higher interest rate? Now they said they want to have this loan paid off within the next 2 years. So if that was the case, they're actually going to save about $1,400 if it takes them 2 years by taking a 3.625 interest rate than they are a 2.5% rate. So this is the cheapest possible option for them based upon their scenario, putting this loan together. So if I would have kicked them back a good faith estimate and said, here's my 10-year rate is going to be 3.625, most people would go, holy cow, you're amazingly expensive, but and not even consider it. When the reality is, based upon their cash flow and equity objectives, their short-term financial goals, this is hands down the cheapest option. So I've harped on this before. It's not always the lowest rate, the lowest payment. In this case, this payment ends up being, what is it, about $50, I want to say, more expensive than this payment, but it still ends up maybe 55. I'm ballparking here. It still ends up a cheaper loan because we're saving this money up front to the tune of $2,700. Well, $2,700 divided by 55 means it's going to take us about 5 years, at least 4, before this loan saves you any money and they're going to have it paid off by then. So I hope this makes sense. I do this every day. I see these things every day. I see people chasing low interest rates, low payments every day, and that's how banks make extra money. So I think they have plenty. I'd like my clients to have a little more. Therefore, I go through this exercise. Thought I would share with you as well. Any questions, give me a holler.